Welcome everyone to CSI Live. It's February 18th already, and we have a very special guest with us today. This is Simon Erickson from Seven Investing, and we're super happy that Simon's here, taking the time out of his day to hang out with us.
Casey and Nick, thank you very much for having me. I still remember when you guys started your business. I've been supportive of it the whole time. I love what you guys are doing. It's a pleasure to be here on your show.
You were very supportive, and we appreciate that very much. And it's a shame it's been so long in getting this together as a result. So let's
Yeah, we're sorry it's taken this long.
We're ready. We're ready. Let's powwow.
we're making amends here and then some, hopefully. Should we start with like an
Yeah,
intro for you, Simon? I think everybody should know who you are because I think I think there's an interesting angle here in introducing the topic, the hyperscaler CapEx. But anyways, let's do some intro.
yeah. What's brought us to this moment right here?
Yeah, so I founded the company called Seven Investing. Our website is appropriately seveninvesting.com. The whole purpose was to empower individuals to make better investment decisions. So go out there and do a lot of the legwork, find the innovative pockets of the market, and find the companies that are the best opportunities to put to work. If you want to buy stocks and you need some ideas, we've got one new recommendation and five best buys every month there.
Nice.
Nice.
Yeah.
Sorry. So what did you do before, Simon?
Oh yeah, so I'm an engineer by training. I was a chemical engineer, and then I went into technical sales, which was code for travel 4 days a week and go through different airports and Courtyard Marriotts and cities all across America. But from doing that, it was kind of always seeing some neat stuff that was going on out there. What were companies wanting to do in the energy industry? What were people wanting to do in agriculture? What were the trends that were developing? And from that, I went back, got an MBA, and then kind of went into a role with the Motley Fool as an investor. So rather than running things and operationally on the internal inside of a company, looking at them and assessing them, and evaluating them from the outside as an investor, but still really kind of focusing on, what is new, what are companies excited about doing, what are the trends that we should be investing in. And then in
Mhm.
2020, took on Seven Investing, took the leap of faith, started my own business, had the whole scorecard, as a responsibility rather than just contributing to a larger whole. It was kind of, go out there and pick a stock or a few stocks every single month. And hard to believe it's 6 years in already, Nick and Casey, but here we are. It's been quite a journey and quite an exciting path.
It is, and it is crazy. It's been 6 years since you did that, and we have some questions for you on that at the end. Someone asked, I think, a very poignant question given where we're at this point in time with AI and disruption of everything, it seems, or at least that's the narrative right now. But so from your start, in your career as an engineer, it would be great to talk about CapEx because you were in the corporate world on this and privy to big decisions and allocations of capital and how that meets the engineering side. So we thought talking about hyperscaler CapEx would be a good thing because this is I don't think we need to argue the point that the biggest like technical deployment of investment ever.
Yep.
It's huge. From the numbers we're talking about are just absolutely wild. So let's get into that.
Yeah, and even thank you for bringing that up because one of the things I didn't even mention was kind of an interim in there where I was working at Chevron, right in the venture capital arm of a
Mhm.
large oil company, Fortune 10 company. And we were kind of sitting between the new technologies of venture capital and the actual deployment of pilot programs. So it was kind of you find a new technology, you bring it in, and then you start putting some money behind it. And every company, including the hyperscalers, including, Silicon Valley's finest, have got their own internal metrics that are the hurdle rates or, whatever it is that they're looking at to justify the large projects and what they're spending it on. And so I think
Mhm.
that even though we're sending what did we just say, Nick? $364 billion last year between Meta, Microsoft, Alphabet, and Amazon spent on CapEx. I mean, that is clearly, whether they're using that internally for their own consumption of computing, for their own applications and their own software, or they're renting it out for the instances of others, from the infrastructure that they're providing for them. they're getting an ROI on that. I mean, it's clear if you're spending that much money, you're not just burning your money. There's a clear ROI on all that spend.
So would that be safe to say, from one of the stints in your career path being VC and deployment of capital, what's your viewpoint on the hyperscalers right now? Are you invested in any of them? Why or why not?
We were talking just about the full stack, on the last show that you and I just filmed, and how important it is to not only control the hardware layer, but the software layer. And then the user interface too. I mean, like a company like Google is one that I do invest in. Alphabet is a company that, I've been invested in for years, just because I think that they handle it so well, from designing and deploying their own hardware to putting the CapEx to work to getting it up and running, and then also controlling the interface, whether Gemini or anything else. It's a prompt for users to actually make use out of. And that's why they've got, what is it, Nick, 8 billion user products that they've launched globally. I mean, you can really get a bang for your buck on something like that and put some of the smartest minds to work. So yes, I am invested in Google. I've invested in Amazon for years and years and years. But in terms of hyperscalers, those are probably the only two that I've held as long-term investments.
Okay.
Maybe I'll, while you're talking about this, I'll share some of the CapEx expectations for 2026 here, because they're impressive. Does it make you nervous with all of all of this CapEx spending, Simon? Does it worry you at all being an investor of Google and Amazon?
It's crazy, Casey, because everything is so cutting edge and expensive right now, right? NVIDIA is making, what did we just say, Nick? It was an 75 or 80% gross margin for the GPUs they're deploying for, the Blackwell chips. It's, companies, the hyperscalers are of course doing some of that design work on their own. You've got your own TPUs that Google wants to do for its own data centers, and it might not have to deploy as many NVIDIA chips because it wants to deploy its own, that it doesn't have to pay 75% gross margin to buy. But then on top of that, we were discussing that Apple is notoriously absent from the CapEx spend that's going into this. This is a great graphic you've got out here of how much companies are spending on CapEx. Apple is not. Apple's lack of participation in CapEx right now, at least compared to the other large tech companies, seems to suggest that there's going to be either a commoditization and a driving down of the price point of the cutting edge AI chips, at least compared to where we are today, or Apple's just going to be able to push up so much volume and so many economies of scale that it's going to do exactly for the new future of AI, whatever that looks like for its device of what it's going to be, the same thing that it did for the iPod when it pushed down, the price of memory that you could be held into an MP3 storage device, or an iPhone with the components that went into an iPhone, obviously to a consumer price point that people could afford for a couple $100s. I feel like Apple's kind of at that. I've been waiting for 5 to 10 years and seeing how that's playing out. But if we know Apple and we know how they like to go big, rather than not participate in these trends, they're just a little bit more patient in that. I just wonder if we're overspending right now, and there's a more patient, efficient way to deploy CapEx, which is a company like Apple is waiting to do.
Yeah, here's in comparison with the previous two slides with Google and Amazon CapEx. Here's the Apple CapEx you are talking about, Simon. This is pittance in comparison to the hyperscalers.
Yeah, that's only $12 billion, right, Nick? I mean, gosh, that's not even $100 billion a year yet.
No, 12 billion, and it's been flat for a decade, which is insane. Like you're right. They're up to this point, both what Apple has said publicly and also, I'm sorry, I'm gonna before we get into the next question here, because you brought this point up and it's a good one, Simon. Both the financials and the actual pace of product releases from Apple definitely indicate they're just saying we're going to bide our time and wait until we can do whatever our Apple thing is going to be in this. And so, yeah, what has to happen to get them into that market? What does it end up looking like? We have to assume it's going to be a consumer product of some sort, consumer / maybe also business product that has that Apple flavor to it, where it's maybe not something brand new, cutting edge. That's been Apple's hallmark is in everything they've done. It's not like they invented a phone that also had an internet connectivity. but they just did it so much better. And then their ability to monetize that and get people excited about it was unparalleled. So what's it going to be is the big question, I think.
Or even just, do we need to put more and more horsepower into the engine, right? Like the famous saying, it's the early bird that gets the worm, but it's the second mouse that gets the cheese. It's like maybe Apple is getting smarter from the mistakes that everyone else is spending hundreds of billions of dollars doing. But if you can actually define how you're doing the computing more efficiently using software, then that might not require you install as many NVIDIA chips or as many XPUs as you're putting out there. I actually just had this conversation with my web developer yesterday that runs our seven investing site of like, how are we using our computing resources? Are we doing this efficiently? And we realized that by changing up, this is a simple example. We're very small compared to Apple, but just by changing filters or the rules that we have on how we're using computing for our own resources, we were probably overspending on the resources that we had signed up for. And you just think about something like that, where every single percentage point of efficiency matters billions of dollars. And a company of Apple's scale, I think they're doing a lot of learning at the expense of others for these last couple of years, in my opinion.
Well, I think it's more than an interesting point though, because that is most certainly probably what they're doing just based off of how they've done things up until this point. And they're fine. They're doing more than fine, continuing to just wait and bide their time. Obviously not the fastest growing hyperscaler, Magnificent Seven company, but that's fine because they wait for costs to come down and control those expenses. The earnings per share growth is still there. And so Apple stock, in spite of, I know we don't have a direct stake in Apple anymore outside of our tech ETFs, tech slanted ETFs. The earnings per share growth is still going and keeping it in the conversation as one of the largest companies, if not the largest at times, company in the world. So I think it's a good move for them at this point to just say, you guys have fun building this infrastructure out, and when the dust settles, we'll see what we can do with it.
Yeah, and perhaps to put one more analogy to it, if you have a continuum of how well do you know your customer and know exactly what your customer wants and letting that guide your spend rather than just going out and being cavalier about spend. This might be a controversial take, but I'm going to throw it out there anyway. We're amongst 12 or however many friends we've got here, that are listening to me live. So this is going to stand. But I would suggest that Apple is at the far end of the continuum, the very best of the continuum of understanding what a customer wants to buy and having a loyal customer that loves their product and it's exactly what they know that they're going to want. Whereas perhaps Meta is on the other side of that continuum, at least amongst the hyperscalers. When Zuckerberg says, look, we're going to go out there, we're going to build the metaverse and we're going to spend $10 billion and hire 10,000 engineers. And then everyone kind of came back and said, yeah, but I don't really want VR in my life right now. Maybe we're going to put that off for a couple of years, but we're going to shelf that project. Apple would never do something like that. They're going to understand everything very, very well before they launch a product. I think that's where we are in the life cycle for this right now.
That's a great analogy. Yeah.
That's so true.
I don't think Meta runs its social apps because people think it's the most wonderful experience ever. That's definitely not how they make their money.
You've been on Facebook lately, that's so true.
Okay. Let's go back to the question.
Yeah.
What's the next question here? Because the Apple's it's a good sidebar, but they're definitely not doing any CapEx crazy things right now.
I get the next question that we were thinking of is, will there be a big AI payoff for all of this CapEx spend? We're discussing a little bit of it right now, but we talk to our viewers all the time that in some form, AI payoff is actually happening right now, but we're constantly looking for revenue increasing for some of these AI startups to value this success. But how can we value that? How can we value the success of all of this CapEx spending?
I mean, perhaps OpenAI is a quintessential example for this, right? I mean, if you look at their own forecasts of where they think they're going to make their money, I mean, right now it's kind of mostly just a free prompt. What have we surpassed 1 billion users for GPT now? I think it's right at around 1 billion users. and maybe I think it's 50 million of them are actually paying at least $20 a month for the basic plan, or the pro plan is $200 a month. But there's going to be advertising. Of course, we know that advertising is going to be a huge component of that. Just like Facebook did the exact same thing, get the users first, get a billion people on the platform, and then figure out how to monetize it later once they've got the stickiness and you got people that start exploring because they're familiar with it. I think the same thing is going to be true for the large language models, for OpenAI. That's why they're developing these and trying to perfect them so that people will stick with that. Even though I don't even know that OpenAI has strong competitive advantages. What is it? Gemini's up to what, a 25% market share already versus GPT. It's just been very quick. There's no switching costs between these right now. There's no lock-in for a lot of these. But I do think advertising is going to be a big part of it. And then the agents, the AI agents, can you get this on the enterprise side of it? Certainly of interest to Microsoft and Salesforce and the companies that already have those relationships. But if you were previously charging subscriptions, for licenses for per people, that's going to be switched to a usage base for an AI agent, and a lot of that is going to be captured by those companies that cannibalize themselves because they have to.
On that, because that's an interesting insight. You've said this many times here that ultimately AI is probably the biggest monetization. There's definitely the consumer side of it as well, ads, but the greater AI ecosystem beyond just OpenAI and some of these more consumer-facing chatbots, LLMs, is going to be an industrial process. It's going to be an industrial product. That's where some of the biggest monetization and the biggest profit gains are going to come from. Where do you see the business model going for this, though? Because you talked about we've all been trained early on now to just endlessly prompt these LLMs, but the economics really get unwieldy pretty quick if you're a business and your employees start treating it like ChatGPT, and your compute costs go through the roof. What needs to change to make this like an economically viable thing? Because that is the promise of AI.
I mean, unfortunately, the first easy one, the cost savings one, is replacing human labor. I mean, you just see the mass layoffs of the tech sector. That's the easy way to use AI. If you had 10 people doing something that one person can do more efficiently than a team of 10, you pay one full-time employee with full-time benefits, and then the rest of it. The AI doesn't need vacation days or healthcare. That's going to be the easy one. It's just the cost savings, and you're going to see the operating margins of the companies that are deploying AI go up because this is a benefit to them. On the revenue side of it, outside of advertising, which is just selling more things on the retail side of it, I do think that is probably one of the biggest revenue drivers. Is AI going to be more efficient in improving the sales funnel than, hiring direct sales reps, moving to inside sales reps, moving to inside, sales models, kind of things like that? Can you just use AI to go out there and advertise for you and get conversions? We used to pay marketing folks a lot of money to run campaigns, to set up campaigns on Google and Facebook and wherever they used to, wherever they might be. Can you just let AI scrape all the data that you have to do that for you? Probably that's a revenue driver in and of itself. And then, I mean, where is the money? Where is the big money that we're spending trillions of dollars on today that AI can actually save a lot? And I think that healthcare has to be one of them, and energy has to be one of them. These are inefficient markets worth trillions of dollars that need AI, but because of regulations and just because of a slow pace of innovation, they just haven't quite gotten there. I come from the energy industry, so I can say that, but I think there's going to be a lot of progress in energy and in healthcare that's AI related, even the next decade.
Yeah, that's interesting. Interesting insights on that about eliminating inefficiencies, especially in these industries that are notoriously that. And advertising was that way before. It was highly distributed among endless number of competitors before the internet era consolidated it. Okay, let's
There's some interesting applications to that too, Nick. I'll add just an anecdote on this too. I was having coffee with a buddy of mine who is a registered nurse, and he's kind of discussing with patients and talking about how doctors kind of talk about patients generally to diagnose things. When they come in, they kind of think they know what the problem is, but a lot of times that's not actually entirely the truth. And so they've broadened the way that they talk with patients because they now have an AI that's recording the conversation. You have to opt into this, of course. It's not always doing this. But it might, instead of just being like, what part of you hurts right now, or what do you think is wrong with you? It's more of just describe some of the things that you've been doing in the last 6 months and describe where you started noticing a lot of the issues that you've been having. And it will pick up cues that it then connects the dots through the correlation of machine learning to say, oh, we think this person is at risk of having a stroke because of 1, 2, 3, 4, and 5, or whatever it might be. A lot of that was harder for a human being to be able to keep track of that many parameters and make that many correlations in healthcare. But you just think about with this much information and as this much as we've learned from diagnosing and treating patients for decades, it'd be fascinating, right? And think about how much money is spent downstream of even patients coming into a primary care physician to get something very simple looked at that later goes on to a very serious condition. I just think stuff like that is very, very interesting. And again, very, very costly to America.
Yeah, you're absolutely right about that. We've talked amongst ourselves about this a lot, especially with some of the companies that specialize in specialty testing, preventative cancer treatments, preventative cancer tests, and then treatments, matching the right diagnosis, the right treatment, the right maybe trial. Some of these companies, now I can't think of, it's not Twist, not
some of the IPO
Yeah.
ones that recently IPO'd, not Guardant Health, but
no, Caris Health Sciences, and then another one that it slipped my mind, but they're doing really amazing things. Ultimately, I think it's going to take some time to make it right, because there's still a lot of nuance to healthcare. But I completely agree with you. I think having more data and that being more widespread worldwide, even for just the simplest of things, can really help with especially preventative measures.
Yeah. And I know I'm preaching at the choir. Yeah. I know I'm preaching at the choir with you, Casey. You have a background in healthcare and data analytics, so you know this even better than I do, how important that is and how that industry can be challenging in its own ways sometimes.
Yeah, no, it's changing fast though.
Yeah.
So I want to come back to this idea of now even regulated, highly regulated industries now up for disruption or benefit, perhaps maybe is a better way of putting it, because of AI, the finance industry and investment industry. But before we do, what camp are you in, Simon? Are we nearing 2026, like some peak in CapEx spending? Or is there more runway here left to go, just given how much of the global economy has yet to really be touched by AI yet? What camp are you at? Peak? Are we nearing a peak, or longer runway and more steam behind this than anyone thinks?
It's an interesting question. I don't think, I mean, like peak is like one of those four-letter words that gets thrown out every day. It was like, it reminds me of peak oil, right? Or like, peak, right before the internet, it was peak fiber. Remember when telecom was spending so much money on fiber optics and they said, oh, that was a bust, that it took 20 years to recognize that the ROI on those investments. But yeah, but it still was necessary. The layer of fiber was necessary for high-speed internet to take place, right? So I think it's the same thing with the CapEx right now. I don't think I mean, maybe you get an immediate payoff for $100 billion in CapEx spending in a single year. These companies are massive, but I don't think so. I think that this is more of the long game that they're playing because it's an arms race out there, man. If your competitor is going to spend that much money and have that much capacity for AI, can you fall behind? Can you allow yourself to not spend that? Apple has got a completely different strategy, but I think that, when it comes to Amazon and Microsoft, um, that maybe that's a little bit more of a, you've got to keep pushing because your competitors are going to do exactly the same thing. Kind of like the standoff between the United States and China right now. Who wants to deploy more computing and who wants to give more government grants to encourage domestic supply of these things. I mean, it's kind of like at some point you got the chip war that's going on, where the industry self-fulfills its prophecy of spending more money to accelerate the innovation.
Yeah, that's right. Yeah, it is tough, especially in a capitalist system where ROI is an absolute must as investors to get a return. That's the reason for investing. But that is a difficult trade-off, though, because eventually to get that future ROI, sometimes you have to burn the cash now. And we never want to talk about that. We never want to talk about losing money on investment. So it is an odd little period here when these events like this happen, like right now or during the dot-com boom years, because that's absolutely what's happening. There's going to be at some point some level of the CapEx unknown today that gets spent over and above what is ever going to get positive ROI, but it still has to happen, unfortunately.
Which is so curious, right? Like here we are having this conversation about we don't really know how this is going to get monetized, and yet companies are spending $300 billion on CapEx every year. It's almost insane. I know this was true a couple months ago. I believe it's still true today that within the last 12 months, there has been more of a contribution to America's GDP growth over the last year that came from CapEx spending for AI infrastructure than there did from consumer spending, which consumer spending has traditionally been 70% of America's GDP. I mean, it's just insane to see where the stock market's gains and where the GDP of America is coming from right now. That's a sidebar conversation in its own right. That's a two-bear conversation of its own, but just so much is being spent. I agree with you. It's an insane level right now, Nick.
Yeah. Oh, okay. Yeah, we could go another time, another round on really, really big, beyond macro, far-reaching implications of all this, because over the next 50 years, the economy will dramatically change in industrialized countries. And maybe this is just the beginning of seeing that shift from a consumer-oriented economy to something else, whatever that looks like. But okay, back to the here and now, though, because we did have, we do this one first. We had a question from someone that I thought was good, but we have a live question from Pushkar.
Pushkar made the comment, while implementing AI in healthcare, one has to ensure that it is being trained on a valid data set. In many fields, absence of valid and correct data sets is the biggest bottleneck in deploying AI, which is absolutely true.
Garbage in, garbage out.
I would say one use case, just very briefly before we get back to the comments, but one use case that I think AI has been amazing in healthcare is like for a company in like Intuitive Surgical, where they're providing software to help surgeons make in the moment decisions, and then also using those decisions to help train other surgeons on using their Da Vinci machine. So, or even their Ion machine for lung biopsies, using AI to map out the lung, help see those nodules that need to be biopsied. And these two things are just, in my mind, like really amazing use cases for AI that will most likely only get better. It'll improve upon itself, and it's because it's being trained by real world data. So.
Yeah, and just one more, another idea, it's tangential to this. You know, I was just speaking last week with one of my former advisors, Manisha Samy, for our show, and she's very big on innovation in biotechnology. And she brought up a company called Recursion Pharmaceuticals, RXRX ticker on that one. But again, completely different infrastructure, AI native infrastructure for drug discovery. So it's not just about get the blockbuster drug to market as quickly as you can and get to $1 billion in sales. It's about improving the speed of drug development and looking at the value of the assets that might be unconfirmed assets in the pipeline versus what you're out there and selling right now. I mean, that changes the entire way that we value biotech companies or pharmaceutical technologies, where it's all about price to sales, price to peak sales. There's that peak word again of what's commercialized today versus what is the probability of success. You push that up a couple percentage points of stuff in the early stage pipeline because you're using AI, all of a sudden you're unlocking a lot more value for a lot of these companies that have been ignored for a very long time.
Yeah, absolutely.
Yeah, huge waste in some of these industries, to say the least.
Waste. Yeah.
Yeah. Okay, before the finance thing, actually, I forgot one more thing. So we do like to get an outside perspective, as one of our community members put it to me not too long ago. especially if we're doing like all this stuff with semiconductors all the time, there's risk of like there being an echo chamber effect. So Simon, coming from the outside in, like throw a wrench in the gears here, disrupt the echo chamber, throw up a wall to stop the echo. Where do you see the semiconductors in 2026? We talked about the CapEx boom. That's obviously going to be a benefit, but where are we at in the semiconductor world from your perspective? Are we peak semiconductors, peak hardware cycle? Or do you see this runway continuing for them as well? Because the risk, obviously, with semiconductors, the biggest benefit of them is they get cheaper over time, they get more powerful, and they get cheaper. But that's also like the worst part of them too, is you get commoditized and the business is not such a great investment anymore. Where do you think we're at here in the cycle for chips for semis?
I will say I think there's more pressure than ever before to take a look at the manufacturing process of semiconductors that has mostly been largely unchanged for decades, right? We have still, I mean, this is still a very capital intensive process, and that's why fabs are costing $40 billion on the low end now. And you've seen on the back end of this, and you know this even better than I, Nick, but like you've got companies, the BE Semiconductors of the world, the advanced packaging of the world, there's stuff at the very end of the downstream of that process you can get creative about to save some costs and get some efficiencies out of. And then even in the middle process, in the etching and the removal of, some of the, when you're etching the transistors and deposition, stuff like that, Applied Materials is doing a lot in the middle, whether it's the interconnects or the vias or the shape of the interconnects and stuff like that. They're doing some cool stuff. Centura Sculpta was a new machine. They're doing some neat equipment design changes to make that more efficient. But still, the most efficient, the most capital intensive part is at the very beginning, at the lithography of ASML, right? And ASML just released its newest high numerical aperture machinery that is 350 million US dollars per machine. And the lead time is what is it, 6 months to a year to even get it installed? We know that Intel installed some of them, but my goodness, if we're going to be producing as many chips as we want to be producing, and we're still waiting 12 months lead time for a necessary EUV machine that costs $350 million, I think AI or something or someone needs to look at this process and be like, how can we do this more efficiently or less capitally inefficiently that we're doing right now? And I
Mm.
don't know what that looks like. A lot of smart people have tried to do this and failed. And ASML is probably as close to a global monopoly as I'm aware of out there, with some fantastic technology that is very, very difficult to replicate with thousands of suppliers, supplying thousands of parts that are proprietary just for them. But just the idea of, heating something to a temperature that's hotter than the temperature of the sun and running it in a vacuum and everything that we're doing to produce these 2 nanometer transistors that we've been saying Moore's law is dead for years. We've been saying that atomic forces are going to interfere with how efficiently electrons can even flow through a semiconductor chip. I just wonder if the way that Silicon Valley has optimized this process for the last 70 years necessarily has to change in the next wave of AI going forward. That's
Mm.
my only pushback on where things are going. Other than that, the numbers speak for themselves. People are spending a lot of money still, for sure.
Yeah. Well, that's an interesting thought that a lot of engineers are working on, because you're right, that is the ultimate bottleneck in the manufacturing supply chain, which doesn't always translate into up into the right growth for ASML all the time. So there's got to be another way to work on that. The challenge will be changing all the other myriad of steps around it as well. And it'll have to be a lot of cost savings to get everybody to move off of that process and say, okay, everything we've been doing up to this point is sunk. Let's move on because this is so much better. It's an interesting thought. And maybe these are the type of conversations that Elon Musk is having with his team right now on this terafab idea. It would be a monumental undertaking just to even begin an R&D process to figure that out.
And if anyone's going to do it, Elon Musk is going to do it. He already wants to put data centers in outer space to get the temperatures down and to get, the gravity not to be a factor. Um, wow. Okay. I mean, that sounds scary to me, but if anyone's going to do it, Elon's going to push the bar and disrupt industries. He's done it several times already.
Mhm.
I'm with you, Simon. That does sound scary.
A data center floating over America. I mean, okay, maybe. I don't want to be underneath that thing, but maybe he will.
Maybe we should talk about a company called Space Forge sometime. Private business, but maybe space will yield some discoveries and yield some enhancements in the process, where here under the gravity and the atmosphere and everything, it's just a limiting factor. But okay, I know there's questions out there, and the biggest one that came up, Simon, related to AI, going back to like the opposite end of the spectrum here now, the software layer. We had a question on the future of investing. So you've been at this for 6 years now, which means you've seen some massive changes already in your workflow and what you do. What do you think AI is going to do to like the stock picking investment services industry in the coming years? Also highly regulated. What's going to happen here? Where do you see this heading?
I am a believer, I am a true believer that empathy is the most important thing that humans have over AI. I still believe that there is an interpersonal connection that we have that you'll never replicate, even with an AI girlfriend or an AI relationship or anything like that. There's still a connection between human beings that is very important for a lot of industries, healthcare being one of them, like we just talked about. I think investing is one of those too, Nick. When people say, what stock should I buy right now? You can go to GPT tomorrow and say, what chip stock should I buy? And it's going to give you an answer. Now, do you trust that? How did it come up with the answer? How did it, what are the biases of the algorithms to decide those kinds of things? And then also, are you able to interact with people and just talk about it? Like, hey, I bought this chip stock investor idea. Nick, what do you think about it going forward? I still think there's an empathetic human connection piece of this that is very important in our industry, in the investing industry for sure, because so much of what we do is just credibility and trust. And it's like, if somebody is going to jump out there and scream YOLO and buy a bunch of meme stocks and make a ton of money and show how much money they made, do you still trust that's a sustainable way to compound wealth over time? Or can you show, this is a lifelong journey. Investing is not just a prompt you plug into an LLM for a quick answer, but something that you can compound knowledge, just like and compound wealth over time. I still think there's relationships in the investing industry that will never be displaced by AI. But certainly this is a tool that I use every day that's a lot more efficient than what I was doing when I first started doing this in 2013, which I'm thankful for because AI has saved me a lot of hours running through annual reports for sure.
Yeah, it's definitely has been a huge time saving technology for sure. So this time though, maybe to push on this just a little bit more though. So I'm coming from a background of investment management, and indexing was a big disruptive force, was successful. The market makeup is very different today because of index funds, the rise of index funds. It was a technological, maybe less of a technological, maybe more of like a mathematical advance for the industry. I remember getting our firm started. The first kind of initial wave of robo advisors was coming out as well. Those didn't work so much, but it also did alter kind of the path of investing a bit, even though maybe the pure robo advisor model didn't work. What do you think AI could do to, like, at the very least, alter the course of the way, not just the way our workflow is, but like the industry itself? Is there something about the finance industry and investing that could be altered as a result of AI getting adopted by some upstart competitors?
It has to be responsible, Nick. I mean, like it goes back to, if it's the Warren Buffett quote, right? Don't let options be financial instruments of mass destruction. It's the same thing with AI and the long-term capital management that blew up when they tried to use algorithms to, predict stock picking behavior, decades ago. It's the same thing today with just more sophisticated tools. If you can train it to be responsible and manage a portfolio based on rules that you put in there, that's fine. There's nothing wrong with the robo advisor that's doing that. I just don't want the robo advisor, somebody who might not know exactly how to specify the rules it wants it to be, to say, go out there and make me a lot of money, and then all of a sudden it finds, the inefficiencies of the market that are not sustainable over time, but then that collapses and people will lose a lot of money from that. I've seen plenty of people posting to TikTok doing stupid things and then losing a lot of money very quickly. We do not want to have a steroid shot of AI that enables us to do more stupid things. But is there something to be said about the meme stock craze, about GameStop, about inefficiencies in the market where hedge funds were manipulating stock prices because they had, unequal access to information? It wasn't that everybody was seeing it, but some people that were posting out there to Reddit were seeing these things and took advantage of that. And of course, the people that were suppressing these stocks for their own benefit, because there was an unequal access to information, were getting away with it. I think something like that just changes the way that investing goes. I think that trading every single day, which is now 90% plus algorithmic, is changing with AI, knowing that when there's money out there, any kind of inefficiency that's in the market or arbitrage that's in the market is going to be taken advantage of by somebody. And that used to be kind of, those who knew it or those who were looking at that were making millions of dollars off of it. I don't think that's true anymore. I think that actually retail investors have a huge advantage from more universal accessibility to information that AI is allowing for.
Yeah, that is probably very true. One aspect where the retail investor crowd claim holds true. Now, I think there are some nimble funds, hedge funds in particular, maybe that can have those same advantages as well. But like your older plain vanilla mutual funds and index funds that are beholden to rules and are incentivized to kind of just be happy performing perhaps just a few basis points over and above their index, or getting just the same return but a better risk adjusted return, and they're happy within those confines. They're not going to get fired for doing that. Retail investors aren't beholden to rules like that, and given the right information, the right data, stripped away of the harmful noise, yeah, I could see that. I could see retail investors being able to remake the financial markets, especially if given new AI tools in order to continue to increase that edge that they have.
Yeah.
Yeah.
And Nick, you said earlier, and we discussed, I guess, an hour ago or so, you gave me a nice compliment. You said that I'm an eternal optimist or something along the lines of I always see it as the glass half full. I want to see good coming out of this, but I also want to know there's going to be some bad behaviors and some bad actors that are going to use this for things that are, in my opinion, not good for the industry as a whole. For you and I that have been in this industry for more than a decade, we've seen kind of some of the things I'm not as much of a fan of that AI is encouraging, right? I've been critical of Robinhood in years past because they have so much money that's coming in from payment for order flow and from margin accounts, both of which I would consider not good behaviors for at least retail investors to be pursuing. You're either paying interest to borrow money when you don't have the capital available through margin, or you're basically front running the rest of the market if you can collect a lot of information about orders that are being placed before they're appearing on the public exchanges. Stuff like that is definitely happening. There's data out there on those things. There's AI that's analyzing that data, and people are making money off of it. Whether or not that's good for the retail investor that I represent, I don't think so in some instances. But I acknowledge it's out there, Nick. I'll still be the optimist. The glass is still half full, but I acknowledge that it's out there.
And it is a good trait. That skew towards optimism is healthy. The market, at least up until this point in the 100+ years of modern financial markets existence, does favor optimism because markets in most years are up. And in shorter periods of time, yes, bear markets are painful, but they last less amounts of time. So optimism is good. Okay. Do we have any questions here?
Yeah, if you do have any questions, go ahead and type them in the chat for us as we're wrapping up here with Simon. David said, if everyone's using AI, then the market is AI and can be beaten. There's always opportunities. Herd mentality.
Always an edge.
Her mentality is just what the market is too, right? Like you mentioned it, alluded to this too, Nick, of the rules that institutional investors have to follow. You almost can't stick your neck out too far or else you get it chopped off. You want to run with the herd because if you're wrong and you do stick your neck out and it turns out to be wrong, then everyone kind of remembers that and you're kind of the idiot that made a decision that didn't play out. Yeah, generally, I think the takeaway is good for retail investors or good for investors in general. More information, and that's generally a good thing if you're investing long term.
Yeah, absolutely. Agreed. Lots of new tools always coming available. Okay. Let's it's been almost an hour here. Let's wrap this up. Sorry, this monitor is frozen. For a minute there, I was scared and thought we had dropped off again. Okay. All right, everybody. This is again Simon Erickson, founder, CEO of Seven Investing. Make sure to check him out, seveninvesting.com. Simon, thank you for coming today, talking about AI, CapEx, disruption or helpfulness of AI. Awesome stuff. Thank you.
Yeah, thanks, Simon. And thank you for supporting us.
Oh, thanks, guys. I'm really a big fan of what y'all are doing. Really nice to reconnect with you here on the show. Keep up the great work, and thanks again for having me.
Yeah, you too, Simon. Thank you. And so we're actually going to continue here. You can hang out if you want, or you're a busy guy. Just say sayonara.
I have one final question. I wanted an explanation on the chef's kiss that's in the background. I always wanted to ask what the meaning or the relevance of that one is before I get out of here.
Okay, yeah. So in this instance, it's not the chef's kiss. It's like the Italian gesture for like,
what do you want?
What do you want? What are you trying to tell me? Or just in general, like if you're expressing pretty much anything emphatically, this.
Got it. I had to ask, Nick. I had to know. I didn't even know. I thought it was just the chef's kiss emoji that you guys really loved. I guess it's an Italian thing, right?
We're channeling our roots.
Love it very much.
We had someone on YouTube like comment about like, we're AI, let me see your hands so I know you're not AI. Like, are you kidding me? Like, when am I not talking with my hands ever? Like, if you watch for like more than 15 seconds, you're gonna see a hand gesture. Anyways.
I have seen AI people with 6 fingers. If you never notice somebody with 6 fingers, that might be a sign it's AI. So thanks again for having me on the show, guys.
Thanks, Simon. Yeah, let's do it again.
Yep.
Okay. All right. Pre-submitted questions.
Okay. First one from Scrublord. You mentioned that it is possible that the businesses who benefit most from software might be the businesses who apply software. As a rebuke for fun, are we overthinking this given that there are proof cases of AI application from software-based companies? Like AppLovin, I guess App is a software-esque company, and Palantir. Both companies are fairly nascent businesses relative to the hyperscalers and are growing revenue at a solid pace.
No, I like the counterpoint. Absolutely. Software, a software business, a business that monetizes directly by selling some sort of software, like the two that you mentioned here, AppLovin, Palantir. Of course, it's not going to go away. And in fact, we'll probably continue to find companies that win big. And even among the existing ones, just in the last week, we haven't really gotten to it yet, but the Shopify Q4 2025 update was obviously fantastic, but talking about all the new features that they're launching in this last year, especially because of the development cycle speeding up significantly because of AI. It's going to be eventually pretty good times, I think, again, for software companies as well, because of AI. This is a weird little little speed bump that we're experiencing for the software industry because of AI. And it really does seem like other past cycles where investors just forget that there is a development cycle. Every business, as uncyclical as it may seem, does actually have a cycle, including software. And we're in a cycle right now as they retool and get ready to ship more products, and there's higher expenses whenever there's a cycle like that. Semiconductors were in that similar kind of type of stage in 2017, 2018, more recently 2022, 2023, when the chip shortage turned into a chip oversupply, for analog especially. These things come up. And so software is a standalone business. Yeah, absolutely. It's going to thrive once more at some point in the future.
All right, thanks for that, Scrub Lord. Allison has a request. Can you make a summary about current valuations and future potential growth in the auto, industrial, and power chips covered by CSI? This way we might find bargains or values among those stocks better, as many of them have grown for 2 to 3 months and are not as cheap as 1 to 2 quarters ago.
Allison, I suspect the question maybe came up before the analog chip update yesterday. We crammed a bunch of companies onto lists in that article. You can bookmark that. We're not going to make tables of valuations though, because valuations change every second that the market is open.
And they're so subjective.
Which is why we've given all of you the tools, hopefully, or at least one tool on how to go beyond just valuation metrics like PE ratios, price to free cash flow ratios, and so on, with that reverse DCF methodology. Hopefully that gives you another layer to your analysis to be able to assess that, because those metrics are going to change with the stock price every day. And even if the stock price remains static, quarterly earnings reports change, multiples as well. So we're just not those investors to like focus on valuation. That's embedded in our process, which is here. All those articles are here and outlined, and that's just not going to change. That's not how we've successfully invested up to this point, by over analyzing valuation and looking at things as being cheap versus expensive. There's a lot of nuance in between those items where you can really actually make money. So check out that update though. Hopefully that's helpful. And as far as the cheapness is concerned, yes, maybe the ratio, the valuation ratios look different than they did 2 or 3 quarters ago, but that doesn't mean they're less cheap. In fact, you could possibly make the argument that some of these names are actually cheaper than they were 2 or 3 quarters ago, given the new information that we have on 2026 outlooks for these companies. So give that some thought, Allison, and we can chat more about that.
All right, thanks, Allison.
Was that it for
we have one for question from Big Mountain on Palo Alto, so we can do the presentation.
Oh, okay.
Yeah, we
Cool.
have that question. Sorry for my frustration there. I was trying to get the right screen to populate.
Were you frustrated?
I was. It was not at what you were saying, just so you know. If anybody's watching this later, they're like, whoa, Casey was irritated.
I had tunnel vision. I didn't notice.
Yeah, I was rolling my eyes and
okay,
all the things. Okay.
What the heck happened? Is the SaaS apocalypse coming for Palo Alto Networks too? Cybersecurity was supposed to be like totally safe and immune. What happened? We're getting hammered here. Let's break it down.
Let's talk about Palo Alto Networks. First we'll show you a very familiar slide of the cybersecurity industry. In 2025, around $215 billion was spent on cybersecurity. The expected annual growth around 12% over the next 5 to 7 years. This is why we talk so much about cybersecurity. This is a secular growth trend in our belief. And Palo Alto primarily focuses on the two biggest portions of the cybersecurity industry, network security and cloud security, but they have made so many acquisitions, moving to the right, expanding their offerings since in the last 8 years.
Now, when we get to the cybersecurity industry refresh that we first did almost 2 years ago, there's a little footnote here under cybersecurity industry, excluding integrators and reseller services. We're going to talk about that layer of the cybersecurity industry a little bit more because we haven't before. But when we're talking about that total addressable market of 215 billion last year, it's probably headed to somewhere around 250 billion this year, 350 over the next 2 years or so. We're talking about like the companies that provide the technology itself and the software versus companies that resell it or that integrate it, sort of like a consultancy firm. Think like IBM or maybe an Accenture, companies like that, which also harbor an important part of this industry. But yeah, just a little footnote there. And let's talk a bit more about the secular growth trend, because this was a natural segue early on when we started Chipstock Investor. Cybersecurity, it is very, very closely tied with the infrastructure. And especially now when you deploy infrastructure, it is in some way, somehow going to be connected to everything else. If not to the internet directly, it's going to be connected to a private network. And even that private network may have vulnerabilities that expose it to the outside world. Very different from a couple of decades ago when just a simple firewall around an office building where you had your PCs and your employees using the PCs sat. Very, very different. So this is a deeply embedded secular trend, embedded with the infrastructure build out itself, with semiconductors. All of it needs to be secured. So obviously a lot is changing all of a sudden because of AI. The rules are once again changing. And so cybersecurity, as it tends to be, a very fast moving industry. And that causes some real serious headaches for investors. This is notoriously a part of the tech industry where you can very quickly make a lot of money, and then you're also very quickly lose that money as a result of this fast-moving nature of cyber market.
So let's focus especially on Palo Alto and take a little walk down memory lane. This is revenues for Palo Alto on a trailing 12-month basis, I should say. In orange, total revenues, free cash flow per share, the blue line. Nikesh Arora, who's the CEO currently, he took over in June 2018. And we'll show you in just a moment how many acquisitions have been made since June of 2018. And that continued until the end of 2023. And then there was this pause. And now we're restarting.
We are definitely restarting the acquisition spree at Palo Alto Networks. This is an important slide though, because this is a company, as you now all know, that has bucked the trend of kind of boom bust cybersecurity companies. They and Fortinet have been around now since around mid 2000s, let's say, when pretty simple in today's terms network security was more than sufficient. And in spite of all the myriad of changes that have taken place since then, the revenue growth rate has been pretty consistent. They've managed to find ways to evolve and change. But take a note there where that middle bar there, the fiscal year ends in July of every year. So I know it's weird. It's kind of weird looking to keep track of this. But when Aurora took over in mid 2018, you see the revenue continued to grow, but notice the free cash flow per share line takes a dip for 2 years after that, when the heavy acquisition spree got kicked off when he came in and started to really, really heavily change Palo Alto Networks and that image of it being just simple a network security provider. So keep that in mind here. Okay. Here's the acquisitions since Nikesh Arora took over June of 2018. In total, we've kept this list running actually since so we actually invested initially in Palo Alto Networks when Nikesh Arora took over in mid 2018. And since then, we've basically kept track of the acquisitions made, money spent. Interestingly, Palo Alto Networks, I'm pretty sure saw one of the times that we published this table, and now they actually do it too, which is fantastic. There's accountability. Directly on their website, you can actually find a very similar timeline and table, chart, showing the acquisitions they've made and money spent. So they're not trying to hide these, but 31 billion in total spent in cash and new stock issuance over the last, coming up on 8 years now, under Aurora's tenure. Pretty crazy stuff. And you can see the deal size getting progressively bigger as time goes on, culminating obviously with CyberArk, the CyberArk deal closing just a few weeks ago. Okay.
So what are they trying to do? Are
Yeah.
they trying to create the Broadcom of cybersecurity?
Or the Berkshire Hathaway of
Or yeah, even
cyber.
better.
Hopefully that is an analogy that holds true. You can see the problem though in this chart. So this is the same chart we showed you. This is revenue and free cash flow per share, but on a quarterly basis. The revenue CAGR was fantastic. From 2021 to end of 2024, revenue grew well over 20%. And mind you, all of that when the pace of the acquisitions, as Casey said earlier, started to slow down again and even paused at the end of 2023. Free cash flow per share, as those investments that they made, those acquisitions they made, started to pay off. Free cash flow per share started to ramp higher. But then over the last 1 or 2 years, the pace of revenue growth has actually slowed. And as they've started to make more investments again, the free cash flow has slowed as well. And in fact, free cash flow per share, not the adjusted free cash flow that Palo Alto Networks provides for a little extra clarity, actually declined year over year in this latest quarter, down 25%. Some of that is from headquarters build out and other one-time CapEx spend, probably on computing hardware and whatnot. So this is the problem. The name of the game has changed once again, as it has multiple times now over the last couple of decades. And so this dictates changes that need to be made in Palo Alto's approach if they want to keep pace with the times and not become like your next gen digital, which still focuses on consumer protection and now actually money management, apparently, with the money line acquisition. So they're making big acquisitions. Where's that going to come from? So investments can come from two places, right? You can pay for them with cash, or you can pay for them with
Stock.
Shares.
And that's exactly what's been happening here with Palo Alto. This is dates back to January 2021. You can see the increasing amount of shares, not a ton, but definitely significant from 2021. 711 million January 2026. It's actually going to increase to between 768 and 773 million by the end of their fiscal year, which ends in the summertime, which will then reflect the CyberArk acquisition. So in the last 5 years, a couple 100 million shares will have been extended.
Mm-hmm. And for a traditional value investor, this is going to be very problematic, right? As some of you here are, you're probably looking at this and thinking, this is the last thing you want to see from a company that is supposed to be maturing. You want the share count to shrink. But this is going to challenge, if you want to invest in cybersecurity, this is going to challenge old preconceived notions. And to be completely fair, it may not work out. But when they decide to issue stock to purchase these assets, the question then has to become, okay, what's going to be the future payoff on a free cash flow per share basis? Because that's what's actually happening here is the issuance of stock to purchase assets. And so that's okay as long as free cash flow on a per share basis continues to rise over time.
The other way they can fund these acquisitions, as you mentioned, is cash. So let's take a look at their balance sheet. And it almost looks like Palo Alto has been readying itself for this ramp up in acquisitions. In red, total cash and cash equivalents. In blue, long-term investments. And then orange is long-term debt, which they paid off in 2024. Just have been adding cash to the balance sheet.
Yeah, so they're in actually a pretty good position to make these deals happen. The debt, obviously, that was to raise the cash to make some of the purchases in years past, was actually convertible debt. And so when they actually paid that debt off early, it was essentially like retiring shares outstanding, reducing future shares outstanding versus allowing the debt to convert to stock. So it was sort of a stock buyback, sort of, in a way. But at any rate, yeah, you can see the ballooning assets on the balance sheet, cash and short-term debt. And so back to the point about free cash flow per share, how do we decide when a company like this is a good value or not? Interesting to see this. This is the stock price in light orange versus the repayments of long-term debt in the red bars and repurchase of common stock. Earlier, back in 2020, 2021, even a bit there in early to mid 2024, they actually did make some stock repurchases to keep the share count actually decreasing at some points in time. But then they flipped in the last few years to paying off that debt, getting that repaid. It would be really telling if at some point now what has become an all-out downturn for the stock and many other stocks as well in cybersecurity, it would be really telling if management decided to fire up a share repurchase program again versus just kind of letting the share count float higher. So we'll keep that in the back of your mind. That would be one way to get a handle on if the stock is a value. What does management think? Because they're very strategic about this in how they choose to utilize capital to expand the business. So keep that in mind. Okay, now on to the guidance.
And we have two slides for guidance. One is standalone, and then the other is with CyberArk. Is that what you have?
Yeah, this is the previous quarter.
This is for the
guidance.
previous quarter, and then this will be, yeah. Sorry, I was like seeing double there for a second. I had to so this was the previous quarter's guidance Q2 for fiscal year 2026. This was before they factored in the finishing up CyberArk's acquisition. So expected 28% year over year for the quarter, and for fiscal year 2026, 26 to 27% year over year for their ARR. And then if you drop down just a couple of lines to their total revenue, mid-teens in both of those metrics. Okay. Ready? Now let's take a look at it. Now that CyberArk acquisition has been completed, ARR 56% year over year on the quarter, and then for the fiscal year 53 to 54%. And then total revenue jumps up quite a bit, 28 to 29% year over year for Q3 fiscal year 2026, and then 22 to 23% year over year for fiscal year 2026. So this is primarily coming from that additional 8-9% is coming from CyberArk.
Yeah, which is what everybody expected. But it seems that everybody was expecting something more than this. And especially not just the revenue guidance, but also the profitability payoff. It seems that maybe the market is coming to terms with maybe this being a little bit longer of a payoff cycle, maybe akin to like what happened in 2018, 2019, 2020, when the first round of big acquisitions took place. So we took some notes here on some assumptions, some updated assumptions from this on the full fiscal year guidance. Basically, it implies about 800 million in additional revenue from the acquisition, most of it from CyberArk, Chronosphere, the observability software. Not much revenue happening there yet. That's a new product launch for Palo Alto, which we already covered before. So CyberArk, their revenue, full year revenue actually was 1.36 billion for full year 2025. They just had a simple press release on this. ARR was annual recurring revenue was 1.44 billion, growing at a 23% pace exiting 2025. So it's actually pretty good. Identity is going to be a good add-on for Palo Alto here. And it seems, at least for the next 6 months, the next 2 quarters, the guidance does hold that CyberArk will probably continue growing at an over 20% pace. But because of this updated guide that Casey just showed on the previous slide, it does imply that the existing Palo Alto Networks business might be decelerating a bit. So that's not what investors wanted to see. Also, in tandem with that, perhaps a bit slower revenue growth than what was expected. Free cash flow margin, this was already talked about before. This was already the guide all along. Free cash flow margin expected to drop to about 37% this fiscal year and probably into the early parts of fiscal year 2027 before jumping back towards that 40% target, 40% or higher free cash flow margin target later next fiscal year and into calendar year 2027. So a couple of notes here to keep in mind.
ARR definitions.
Might have been another little bit of a curveball. CyberArk defined its ARR a little bit different. It wasn't being based off of actual revenue recognition, but was calculated on the value of bookings at the end of the reporting period. So maybe that CyberArk ARR growth rate was a little misunderstood, and it's going to maybe decrease a bit from what investors were expecting, because Palo Alto's next-gen services ARR is recognized on revenue when revenue is actually reported and recognized.
Okay, so there's been some bad news. Or at least investors feel like this is bad news. So let's run through one scenario, one possible scenario that has the stock price at, you've got it at 152. I don't know what it is right now. But since then, I
don't know. It's been a mega record session for me.
How long has it been? Oh no, it's about the same.
Oh, actually, well,
it's actually popped up.
It's almost at 155. Who knows where it's going to be
anyway
at any second of today, though.
But here's some of our assumptions. Free cash flow 418 billion, which is
4.18 billion.
Sorry, 4.18 billion, 11.3 billion revenue times 0.37. Total shares outstanding expanding to 773 million. Equal weighted used a custom weight, $5.41 for this, growth rate of 8% over the course of the next 5 years, and then a terminal growth rate of 6%, discount rate of 10% gets us to what the stock price is currently at, or around there.
Okay. Hot tip when using this calculator, that this is an instance where you might want to use the custom weight override, because that's what we used for the scenario was $5.41. The calculation is above. So we actually are using full year fiscal 2026 outlook for free cash flow per share as our starting point. So This is for the period that will end in July, about 4 or 5 months, 5 months from now. Okay. Using the guidance that Palo Alto provided us. So they actually, this is a nice thing for all of the flack that the cybersecurity industry gets. Palo Alto is actually, in our opinion, quite transparent about this, so that you can track the profitability metrics and make sure that you as a shareholder are continuing to get rewarded, even though there's all that new stock issuance going on to make these acquisitions. So that's the scenario that we used, that we kind of arrived at here to get to the fair value today. Could be a pretty low bar, or maybe you look at this and think that's given how much dilution continues to happen right now, maybe it's still too high of a bar. AI is too disruptive. Palo Alto is going to have to make a lot more investments than they have already, more acquisitions to get up to speed. There's the newest one that they made, Koi, that they announced anyways, intention to acquire Koi for AI agent security. A huge problem for companies that want to deploy AI agents. How do you keep them secure? Maybe lots of more acquisitions are coming as a result. And so you may think, no way. The stock needs to come down another 10, 20, 30%, or maybe more before I'm remotely interested. It's going to depend on you and your comfort level with the operating model and how they fund their expansion via cash, sometimes taking out debt to raise that cash to make acquisitions, and also the issuance of stock. This is the nature of the cybersecurity industry, and it is not for the faint of heart. All right. Questions?
All right. Ronak says cybersecurity is a space where there's no growth without covering the most complex attack surfaces. I don't know if there's a number that makes these acquisitions make sense, but strategically newer attack surfaces emerging. In this case, agentic with Koi, it seems strategic, and honestly, I liked how quick of a mover they were.
Mm-hmm. You could love it. In the past, fast movers in cybersecurity, it's kind of like semiconductors, right? Remember, again, like these two things they're very tightly integrated with each other. It's very closely tied with the infrastructure and where the technology is moving in the infrastructure deployment. And this is when you have new attack surfaces come up, when the way that infrastructure is built changes. For a semiconductor business that wants to play on the cutting edge, it's pretty similar, right? You get rewarded if you are successful at being an early mover. You can't just kind of lay back and enjoy that early success, though. If you want to continue to win in high tech, you have to keep moving and keep innovating and keep up with the trends, which tends to go around consumer behavior and customer behavior and customer demand. So this is the game Palo Alto Networks is playing. They're choosing to try to stay on the cutting edge. And so it's always going to require a constant investment in that innovation to be able to keep up. It's kind of a very similar thing. And that stuff will lead to some revenue, but eventually it gets commoditized. It's not cutting edge anymore. And then the name of the game at that point is, for all the legacy stuff that you've already accumulated and built, can you squeeze it for good profit margin while you simultaneously keep up with the latest and greatest?
Good. Can you still hear us? We're back on. Okay. Question from Big Mountain.
We're still here, right? Okay.
How are you thinking of the 9-figure Exium Chronosphere deal with a leading AI provider? Palo Alto highlighted in their call. Further validation to continue to trim others in the observability space, or perhaps validating to a certain extent that the software scare won't ruin these types of businesses?
Good question. Big Mountain. Yeah, as you probably know, we did trim the Dynatrace position. We don't own Datadog. This is one of the reasons why we say software, there's no moats in software. And it's tough to continue to sell around one specific type of point solution in the software market and continue to win. Now, some of these names, it also has to do with valuations coming down and getting re-rated as well, for why the stocks have underperformed over the last five years or since IPO for Datadog and Dynatrace and some of the others. However, while it is validation for the observability market to have Palo Alto make the acquisition of Chronosphere, land a big deal immediately, good validation. You could also say, in addition to the validation, though, Palo Alto is not approaching this as a pure play provider of observability. It's providing observability in the context of everything else that it does. What does that mean for some of the other players? Do they need to go the way of Splunk and get acquired? Cisco bought Splunk a couple of years ago now. Also an early leader in like log management, later in observability as well. It was tough to generate good, sustainable investor returns playing in that niche in software. So more platformization maybe is actually the real validation here. Maybe some of these other companies need to start thinking beyond just observability if they're going to be successful in delivering good shareholder value over the long term.
Right, Pushkar says, so is merger and acquisition the only way to succeed in cybersecurity? And should we give more importance to free cash flow margin so as to make sure company generates cash that could later be used for M&A?
Okay, good question. No, M&A is not the only way. You can look no further than Fortinet, who has made some small bolt-on acquisitions over the years, but most of what they do is organic, completely different methodology, and also very, very successful at it. And yes, free cash flow margin is always a fantastic metric, especially if you pair it with free cash flow per share, which is going to measure the dilutive effects of stock issuance. Free cash flow per share growth is a good fallback. When in doubt, use free cash flow on a per share basis to measure the long-term success of a business. Absolutely.
Okay, I'll take our last question here from Allison. When doing a DCF calculation, how long is proper to estimate the auto, industrial, and power chip growth period? Because their growths are cyclical, they have ups and downs. Should we use like 10 years estimate to smooth those ups and downs? And also have some doubts about terminal growth rate. At what rate might be more reasonable?
Good question. And this is a difficult question to answer because you don't know how long the cycle is going to be. It might be 2 or 3 years, could be shorter, could be longer. The reason being is automotive in general is not a secular growth trend. The auto industry is not a secular growth driver of the economy. It's an old, stable sector, industry in the economy, in the manufacturing sector and industrial sector. So you could choose to do it for 10 years to smooth out the results and assume that there's going to be at least 1 or 2 up cycles and down cycles in there, and choose a more moderate rate than what you would use for like data centers, which is a higher growth market. You can still rank it fairly high though, because within the auto industry, electronics are actually kind of a secular growth trend, even though the industry itself is not a secular growth driver. So play around with those figures to arrive at the fair value of the stock that you're considering, of the business you're considering. And then for the terminal growth rate, you're also going to want to use a slightly lower one that you might use for something like data centers or AI or software for the same reason. So just kind of temper the expectations, but ultimately what you're trying to nail down, Allison, and everybody, is you're not trying to make an accurate assessment based on your opinion of where growth is going to go for that business. You're trying to just try to gauge what the market is assuming. And so in this case, you might want to start with the terminal rate, maybe keep it at 4% or 5%, and then experiment a little bit with the length of time on the higher growth more immediate term future, 5 years, 10 years, maybe even 15, experiment with the length of time and also the growth rate on that length of time until you dial in the stock price and what you think by your best guess is what the market is maybe pricing into that stock. And then after you do that, you don't need to think, about what your assumption is. You're trying to think, what is the market's assumption? And is that reasonable? Is that a reasonable assumption? It's a little bit easier because you have information already embedded in the stock price. And so you just decide if it's a good value for you, if it's something your portfolio needs, something that you need.
All right, thanks for that question, Allison.
It's a good question.
Yeah, thanks for everybody for joining us today, all the great questions. We appreciate it. If you have any additional questions, go ahead and put them in for next week's live event. And yeah, take care.
Thank you, everybody. Thanks for being with us on this mega session.
All right, have fun. I'll pet the kids. Don't worry, David. They're getting well cared for.
Yes.
Maybe too well.
Too well. Most definitely.
All right, take care, everybody.
See you around.